Imagine you've just closed out a winning trade, you see that satisfying green number, but then you look at your total account balance, and it just doesn't quite add up. Maybe it's a little less than you expected, or even a little more, and you're left wondering, what just happened? This discrepancy can be a major source of frustration and confusion for new traders, often leading to miscalculations of their true profitability. Today, we're going to demystify exactly what influences your total trading account balance beyond just your profits and losses from closing trades. We'll uncover those hidden currents that can slowly erode your capital, or sometimes even give you a small boost, all while your trades are open. Understanding these dynamics is absolutely critical for accurately tracking your performance and making informed trading decisions. Your trading account balance isn't just about how much money you deposit and how much you gain or lose when you close a trade. It's actually a dynamic sum, constantly influenced by three main factors. First, and most obvious, is your profit or loss from closing trades. We'll delve deeper into that in future videos when we talk about realized profit and loss. Second, are any funds you add to or withdraw from your account. This is straightforward, but the third factor is where things get interesting and often overlooked by beginners. Swap fees. These are charges, or sometimes credits, related to holding positions open overnight. This is the crucial piece that often explains that mysterious discrepancy in your account, making your winning trade feel a little less profitable or a losing trade a little more expensive. So let's break down these swap fees. So what exactly are swap fees? In simple terms, a swap fee is an interest adjustment paid or charged to you for holding a trading position open past the daily market rollover time. Think of it like a small interest payment or charge on your borrowed capital for carrying that trade into the next trading day. When you trade Forex, you're essentially borrowing one currency to buy another. Because interest rates differ between currencies, holding an open position overnight means you either pay or receive the net interest difference between the two currencies in your pair. This adjustment occurs during what we call the Rollover Procedure. The Forex market operates 24 hours a day, 5 days a week, but even it has an official end to its trading day for administrative purposes. This transition point is the Rollover Procedure. Typically, this happens around 5 p.m. New York time, or 0000 GMT for many brokers. This isn't when the market physically closes, but it's the arbitrary moment when your broker processes all overnight positions. Effectively, for accounting purposes, your broker often automatically closes your existing position and immediately reopens a new, identical position for the next trading day. This isn't something you see happening on your chart. It's an internal process. At this rollover point, your account is either debited or credited with the swap fee. It's the mechanism that ensures the interest rate differential between the two currencies in your pair is accounted for in your open trade. The impact of swap fees on your balance is direct. Let's say you start with a $10,000 account. If you're in a positive swap position, meaning the interest rate on the currency you bought is higher than the one you sold, your broker will credit your account. So for example, if you earned $5 in positive swap, your balance will increase by $5 overnight, even if the market price of your trade hasn't moved a single pip. Conversely, if your position incurs a negative swap, where the interest rate on the currency you bought is lower, your balance will be debited. If you paid $3 in negative swap, your balance decreases by $3 overnight. This is why understanding swap fees is crucial, especially for longer-term swing or position traders who hold trades for multiple days or weeks. Those small daily fees can really add up. The part that actually saves your account is next, by making sure these fees don't sneak up on you. Now, where do you find this information? Because knowing your potential swap before you enter a trade is vital. For most retail traders, MetaTrader is a common platform. So let's look at a live euro-dollar chart. On MetaTrader, you can find swap rates in a couple of places. Before you open a trade, go to the Market Watch window. Right-click on the currency pair you're interested in, say euro/dollar, and select Specification or Properties. A window will pop up showing you various details, including swap long and swap short. These values indicate the fees for holding a buy or a sell position overnight. These numbers are usually expressed in points or in the base currency of your account. Once you have an open position, you can see the accumulated swap on that specific trade directly in your terminal window under the Trade tab. There will be a dedicated column showing the swap value for each open trade, updating daily after rollover. Always check these numbers before taking a trade you intend to hold overnight, It's a quick check that can prevent unpleasant surprises. While today we focused on the immediate impact of swap fees on your balance, it's important to differentiate them from your actual trade performance. In upcoming videos, we'll dive into unrealized profit and loss, which is the floating profit or loss on your open, currently active trades. And then we'll cover realized profit and loss, which is the actual profit or loss locked in once you've closed a trade. These concepts are distinct from swap, but all contribute to your overall account equity. Understanding the difference is key to truly evaluating your trading performance. So here's a quick exercise. Pause this video, go to your own MetaTrader platform, find a currency pair you like, and locate its swap rates in the specification window. See if you can identify which side, long or short, would incur a positive or negative swap for that pair. This practical step will solidify your understanding. To recap our discussion, your account balance is a combination of your starting capital, profits and losses from closed trades, any funds added or withdrawn, and those all-important swap fees. Swap fees are the interest adjustments for holding positions open overnight, processed during your broker's daily rollover. This is the thing this whole video was building to. Always check the swap fees for a currency pair before you decide to hold a trade past rollover. It is a critical piece of information for managing your trade's true cost. Amateurs focus solely on pips. Professionals account for every cost, including swap. So, which currency pair are you practicing this on? Name it in the comments below. That initial moment of confusion about your account balance, when you saw that winning trade but the numbers didn't quite line up, that was likely swap fees at play. You now have the knowledge to understand why that happens and how to check it. In our next video, we're going to tackle those profits and losses on your open trades, the ones that are still fluctuating with the market. We'll explore unrealized profit and loss so you can truly understand the health of your active positions before they're closed. Stay tuned. Remember, context beats the pattern, the stop is what saves you, and nothing replaces practice on a live chart.